Um, so today we're going to be talking about home buying 101. So essentially, getting ready to purchase a home. Welcome, Carly. In planning this webinar, I realized that I needed to break this into a few different um, programs, so a few different options for people. So I have decided to have this be a 3-part series. So this first one, we're going to be talking about preparing to buy a house. The second one, we're going to be talking about the steps of buying a home. So from when you start to when you finish. And then the last one, we're going to be talking about investing in real estate. So if that's something that I feel like there's different audiences for these different topics. So I wanted to make sure to have something, for everyone. And it doesn't always make sense to have everyone listen to all of this. Maybe someone's already purchased a home before, but now they're thinking about investing. So this way it can be, the best use of everyone's time. All right. So I am going to ask for a little bit of participation, so I hope that's okay. But is there anybody who lately has been thinking, maybe different questions about the market? What's going on with interest rates? Are we going to have another housing crash sometime soon? Is now a good time to buy, or should we maybe wait until the rates go down? Does that make a difference? Can I even qualify to buy a home? And so my goal tonight is to answer all of those questions. And again, I would love this to be, participatory. So if we're talking about something and you have any questions, please feel free to ask those in real time. So here's a quick agenda. I'm just going to do a quick introduction and kind of welcome everyone. We're going to talk about why buying a home is important. Is it important? We're going to talk about, is now a good time to buy a home? And then when we're getting ready to buy, there's kind of a few big things that we look at. We're going to look at income, credit, and savings and what those should look like for getting ready to buy. And then also we're going to take a quick look at some loan programs that are available to help. Just kind of do a quick overview of those. So I wanted to share a little bit, if you don't know me, so my name's Katy and I am a part of the Callaghan-Winans team. So I'm Katy Winans. My mom is Linda Callaghan. We work together. Combined, the two of us and then our assistant, Kathy, we have about 30 years combined experience in the mortgage industry. So we have a lot of wonderful experience to pull from. And help make sure that everything goes really smoothly with a purchase transaction, which is very important that you have a good team with you. I do always like to let people know that my partner Linda, she speaks Spanish, so if ever anybody needs someone to speak to them in Spanish, she is wonderful. We also have something that's kind of unique about us is we have a background in financial planning and accounting. And we know that, usually buying a home is the biggest purchase that you might make in your lifetime. So we want to help make sure that the purchase that you're making is going to be really sustainable for you, and you're going to be in a good situation for you and your family, while also making sure, helping you to take advantage of the opportunity that home buying can be, and that opportunity that it can afford you. We are really happy to be working with Guild Mortgage because through Guild, we have so many wonderful programs available to help make home ownership possible. So it's awesome. Couple things about our team. I recently did a presentation for some people in my networking group, and we were just kind of reflecting on what are some of our values and why do we love to do what we do. And some of the big ones are service. We love helping to serve other people. Integrity is a big one. Equity, we love helping people to have equitable access to becoming a homeowner. And then also community and community service. Between the three of us, especially particularly my mom and I. These are just some of the organizations that we're a part of and we love to support in our local communities. So that's really big for us. So now that you know a little bit about us, why is buying a home important? So if it's okay, I'd love to open it up if you guys are able to speak. Why do you want to own a home? Do you have any short-term or long-term goals that maybe that will help with? Oh, uh-oh.
Sure, I can share. So I am getting married soon, and I've lived with my partner for about 4 years now, and we love our space. We love renting, but do think about buying a home, thinking about the right time about to buy a home, to kind of settle roots, be closer to family. I have two nieces, so definitely would love to be a little closer and just kind of start up in, a community and just, kind of move forward with that space. So, yeah, just excited to like growing family, yard for our dog, things like that, but also just, um, court, being close to family, community, all that jazz.
Yeah, awesome. Thank you, Nancy. Would anybody else like to share?
I always figured that was just kind of like, what you always like meant to do, right? Go buy your house, get your place, get your bike, make your own. And personally, I want to get back to kind of my family's roots. We were farmers a long time. As my generation was the first one to kind of not have to do that, but we still have the farmer family. But I still have some of those values where I want to be able to have some land, have my horses and maybe a cow or two and stuff like that.
Nice, that's awesome, Colin. I didn't know that you had horses. Very cool. Thank you guys. Okay, let's look. So I think something that's really big for most people is, housing is their largest expense, and becoming a homeowner helps to turn that expense into from, just a straight up expense, right? We're paying rent and we're not seeing that again in the future once that goes out of our pocket. Becoming a homeowner helps to turn that expense into an investment. We have to pay for housing anyways. So, we can do it in a way that we're not getting anything back, or we can do it in a way that then it becomes an investment. Um, Something else that's really interesting that I learned recently is that the difference, when we think about like the wealth gap in the US, the difference between in that wealth gap is approximately owning a home. So the average homeowner has almost $300,000 in home equity. And that's actually just over the estimated racial wealth gap between Black and white Americans in the US. So I think it can be a really incredible tool for helping to close that wealth gap. I just thought that was awesome. And then it also helps to create a brighter future for you and your family, whether that's through, providing savings or helping to invest in future goals, or having that financial security. For example, today I was actually at an expo for seniors, and there was some of the seniors were maybe renting still. Maybe they hadn't been homeowners in the past. And some of them, were homeowners and, maybe had pensions or 401ks that, they had done some planning and setting themselves up for a more comfortable retirement. And you could really see the difference, right? And just how secure that they were and they were feeling in their future as they age. So that can be owning a home can be a really big tool for that. Something to know about home loans is that they're kind of similar to an auto loan. So with each payment that you make, less money goes towards interest and more money goes towards your principal balance. So for the first payment, you're paying a lot towards your principal, a lot towards interest and just a little bit towards your principal. And then each month it changes, so you get a little bit more principal paid down and a little bit less interest that you're paying each month. So since most of these loans are over 30 years is pretty typical for the first time home buyer loan, it can seem like, oh, I'm paying so little towards my principal balance. And that's kind of true. So I think that can be something that people think like, ooh, I don't know if that's really a great idea. But I think what we forget, or what some people kind of miss, is they don't factor in the appreciation that they're going to gain as their home value goes up over time. So when we purchase a home, we're locking in that purchase price, we're locking in what we're paying for the home. But then, we get we do have that, what we call amortization, or that pay down of the loan, over 30 years. But then we also get the appreciation when we're living there. So definitely something to factor into the decision to purchase is your timeline, right? And for someone who is maybe only planning to live somewhere for a year, maybe that wouldn't be a good choice to purchase. So that's something that we kind of course, discuss as well, right? Is this going to be a good investment for you, depending on your timeline? But this is an example. So all the reports that I pulled together today, I did for Aurora, Illinois, because that's where our office is located. And I thought it might be kind of nice and central for the people that were participating today. But do keep in mind that we put these together for our clients based on their zip code. So if you want to see any of these personalized to your situation, I'd be happy, to get together and put those together for you. So this is just a forecasted appreciation over the next 10 years for a home that today is valued at $350,000 over the next 10 years. So you can see the green here is the average annual forecasted appreciation. So that's based on a more conservative forecast. And then the purple line is based on the historical appreciation, which has been a little bit higher on average. So none of this is, we can't tell the future, but we can look at past data. So that's something that I'm going to share with you as well. We're going to look at what home values have done over time to help, I think, you see what I see, being someone that works in this industry all the time, so that, you can feel more confident. So let's see. This is also one of the other kind of cool calculators we can do, is comparing renting a home versus buying a home. And we see over time, for example, there is, in the first year or two, it can be a little more expensive to purchase a home because you're putting down maybe a down payment. There's some closing costs involved, right? Or the costs of buying a home. So that in the short term can make it actually a little bit more expensive to do that. But then if we look at the long-term projections, once we hit year 3 and beyond, it can actually really pay off to be a homeowner because of that equity that you build over time. So there's a lot of negative news around home buying. Negative headlines lead to more views and clicks. And so, we see negative news in general is just so prevalent. And, when it comes to home buying, it can feel really overwhelming as a consumer, and probably like it's impossible to achieve becoming a homeowner. So, again, as someone who sees and lives and, learns about this all day long, being that this is, my profession, I want to help show you some of the things that I see happening in the housing market right now, and then also things that we've seen in the past to kind of give us an idea of what we can expect for the future. So this chart, I love this chart because it shows us the last 8 decades, shows us the annual appreciation over the last 8 decades. So you can see in the 40s, we actually didn't start tracking this data until 1942. So we've got the total appreciation that happened in that decade was actually 129%, which was the highest almost out of all the decades. The 70s were also really high. But all of the years that are green are years when we saw that there was at least a little bit of gain in the value of the home. So you can see some of them are range in amounts from 17%, 3%. I'm just kind of looking at random ones. But then, there also have been some years where the average home price actually went down. So you can see, one of the big times that we think of is like 2007, 2008, 2009. Those were some times, right? You can see in this chart where those prices went down. What you will notice is that even when there's a drop in home values in the short term, they have historically always recovered. And something that you'll probably note from this presentation in general, and maybe you've heard this before, is that time in the housing market is going to beat timing the market. So sometimes I feel like I've heard that described as investments before as well. So, for example, time in market, right? When you're getting in and doing some investing, the amount of time that you have your funds in the market is going to outweigh picking the perfect time to enter the market. And that's very true about the housing market as well. But ultimately, I think one of the biggest goals that I try to, describe if possible to my clients, right, assuming that it meets their needs as well, is, if you can, as early as we can jump in and it makes financial sense and it's sustainable, that is when I would recommend getting into the housing market. So a big question that we get is there going to be another housing crash, right? I haven't heard this as much lately, but we do hear, is there going to be, our price is going to drop? Is there going to be a big adjustment? There's a really big difference between the overall market now and 2008. So my argument would be that no, I don't think that there's going to be a really big adjustment. Or this slide actually has a little bit of a comparison of like what the market looked like in 2008 compared to now. So one of the things in 2008 is there was a lot of inventory. There was a lot of homes that were for sale, more than there were people buying homes. Now we see that there's a really big shortage of homes available. There's very little homes being built. And there's a big shortage nationally. It's between 4 and 5 million units short of, what we really need. There was very irresponsible loan types that were being given out to consumers in 2008. So, and, a little before then. So, you don't need to necessarily know these acronyms, but essentially what they mean is that these loans, the income for people wasn't verified. They were based on what people verbally said. Like they would say, "Oh, I make $100,000 a year," and then the loan officer would say, "Okay," and they would just go with it, right? Versus now everything is very standardized, and we always have to check and double check and reconfirm. We need pay stubs, we need W-2s. It's very important. There's rules that have changed, thankfully, that make it really hard for people to get into a loan. Or I shouldn't say really hard, but they make it where it's a little bit more difficult. It's not just, just check this box and here's a house. It's a little bit more responsible, and that we make sure that that's something that is appropriate, right? And you can afford, and you have an income that can support that home. Okay, let's see. There were a lot of adjustable rate mortgages. So that was one of the big things, if anybody's seen The Big Short. There were these mortgages where the rates were at a certain point, and then when rates were adjusted, which sometimes happens after 1 year or 3 years or 5 years, depending on the loan, the interest rates went up, and then they couldn't afford those payments anymore. So a lot of people were foreclosing on their homes. There was not good options for people who, if they couldn't pay their mortgage, there wasn't good options for them to, get help with that, right? So now there's a lot of options. There's, sometimes you can do loan forbearance. We lenders want to work with you. There's housing counselors through HUD that can help. Nobody wants you to be losing your home. So there's tools available to help. There's also a lot of properties at that time became underwater where people owed more on their homes than the home was actually worth. Which, now we see that people have so much home equity. And let's see, there was a little bit more of a flipper mentality, really quickly, I'm not going to be in this house very long. Whereas now people are, staying in their homes longer and really taking great care of them because it's their investment. So does anybody have any questions on that? Sounds like no. We can go back if anybody does. Okay, so this chart I also really like. It shows the median sale price, and I actually narrowed it down from the national data to the Chicago, Illinois area, because I think most people are joining us from the Chicagoland area. So you'll notice that there are some fluctuations annually, as there tends to be some movement in the summer. So this is based on a calendar year. So you'll see that the median sale price kind of goes down in those winter months at the beginning and end of the year. And then they do tend to go up in the middle of the year in those summer months when it's nice to move and you have good weather and the kids are out of school and it's super convenient for a lot of families. But let's see, overall, we can see with these different, lines on here, we can see that the average or median home price does continue to rise every calendar year. So by jumping into the market sooner than later, you're going to lock in that lower purchase price. So, but what about interest rates, right? So first, something that's important to know is that there are a lot of factors that impact mortgage rates. So these are just some different things that might cause rates to go up or down. There are still outlooks of future rate cuts this year. There actually, every day there's different news that comes out and impacts mortgage rates. So they're constantly fluctuating. But like just today, there was a report that Fannie Mae is thinking that the rates are gonna, go down to the mid to low sixes by the end of the year. And so because of that, we saw that, rates improved a little bit, right? So, just kind of keep in mind that it's very normal for things to fluctuate quite a bit. One of the most impactful things that on mortgage rates is really the economic news. So changes a lot every day. Here is a nice historic look of interest rates over the last 54 years. So we were up at just about 8% not too long ago. So, up here, that was kind of our more recent peak. And then that was maybe 18 months or so ago. And since then, they started to move down a little bit. And more recently this year, I feel like they've kind of stagnated a little bit. But I think something really important to kind of keep in mind, because I hear from people a lot that they're thinking about waiting until rates drop a bit further to purchase. Something to keep in mind is that for every 1% drop in interest rates, 5 million people nationally become eligible to purchase a home. So, something that we saw when rates were really low in the 2020, 2021 time, 2022 even, in that time, we saw that there were lots of people out shopping for a limited number of homes. And so we saw people having to pay quite a bit more, like 10% over even the listing price. And when a home only appraises so much, that your loan amount has to be based on what the home appraises for. So if you're paying more than that, that extra amount has to come from cash, or it has to be paid out of pocket. Versus you have a lot more flexibility in a higher interest rate environment when there's not as many people out shopping. There's a lot less pressure to have to be bidding, way over the asking price. because you're not competing with so many other buyers. Something else to keep in mind too, as we're thinking about, in the future forecasts, there's, again, that 4 to 5 million unit inventory shortage nationally. And it's quite high in Illinois compared to many other states. Especially if we look at like the southern states, there's been a little bit more available, versus, in Illinois, there's Chicagoland, you think there's not really much room to build, right? A lot of the building we see is happening west, quite a ways. There's also, if we think, one of the things that we talk about a lot is the different generations of buyers. So for especially first time buyers, the market for a first time home buyer type of home, you've got a few different, there's only about 50% of millennials. So that's people aged about 25 to 45. Only about 50% of millennials are actually homeowners. So we are seeing that a lot of millennials are now, considering jumping into the market or jumping in. And then we also have these really, young professionals entering the employment market and now entering the housing market, that are Gen Z, or Gen Zers are jumping in. And, then we also, so they're competing for that same type of home. And then we're also starting to see some boomers and like older Americans selling their homes, and trying to downsize to more of a kind of a first time home buyer size home. So there's quite a bit of competition for that particular, that lower starting purchase price home. So, generally what I see recommended a lot and what I would agree with, is that, anyone trying to get into the market, if you can, I would try to purchase before the interest rates drop too much. That way you're going to lock in the best possible price for the home that you're purchasing. And then, when interest rates drop, you can easily refinance and secure that lower rate. But also still being already in that home that you love. Okay. So this is really cool. This is another report that we can, easily put together based on your zip code. This is a local real estate report card. It shows on here, it's kind of a snapshot of what's going on in Aurora, Illinois. So, it actually factors in the data for all of Kane County. So, just as a reminder, you're invited to set up a time with me if you would like, so we can dig into this a little bit more one-on-one based on your specific goals. And actually throughout this presentation, I'm going to have our QR code on here. So if at any point you want to like grab a screenshot or take a photo, I have a option where you can book a meeting with me right on my calendar. So, whenever works for you, we can go through that. You will notice that we really are seeing strong forecasted appreciation. And so one of the things that's really neat that we look at here, so this is the appreciation over the next 5 years. We're also seeing the amount of homes that are being built right now in Kane County. So it's less than 1,500 homes that are currently being built. And then we also see on here that there are over 30,000 renters who can afford to purchase a home that are living in this area. Now, from this data, I don't believe that this means that there's 30,000 renting households that are available. So just something to kind of keep in mind. I believe that this actually means renters. So if it maybe average, even if we divide it by 3 renters in a family, average, it's still 10,000 families renting a home that could afford to buy for 1,500 homes. You can see that there's maybe a lot more people that might be looking to buy than actually there are homes available. So we are seeing, quite a bit of offers, right, for homes, particularly in that first time buyer purchase price point. And that's where, having a really strong team and having really experienced loan officers and professionals to help you with your purchase really makes a huge difference in helping make sure that you are able to secure a home of your dreams. So we're going to shift into the next part of our presentation, which is geared towards helping you understand how to prepare for purchasing a home. But before we do that, and while we're still in this market update kind of time, does anyone have any questions about any of this data? Awesome. Love it. If anything comes up, you're welcome to chime in. So there's three main things that we think about when we are talking about preparing to purchase a home. So the biggest ones are income, credit or debts, and then also assets or savings available. So I'm going to kind of just go through all of those in a little bit more detail. So as when we look at income, this could include, if someone's retired, this could include Social Security or pensions. Just going to let someone else into the meeting here. Hi, Stephen. Welcome. We were just getting into the part where we're talking about the big things to help with preparing for your purchase. So the big things that we really look at are income. So generally for someone who's working, which I think most of the people in this presentation are of working age, not retired. So generally a lender a mortgage company, a bank is going to look for 2 years of employment history. Some things that we, look for are, have you been in the same profession? That can help. We ask like, how long have you been in the field that you're in? So generally we want to see about two years of history, particularly if anybody's self-employed. We have to look at if you have your own business, that's a big time where we have to average the last couple of years just to kind of make sure that you have a stable income. We also have to have 2 years of history for anything above and beyond your base pay. So if you're an employee who, maybe has a low base salary, but then you have quite a bit of overtime or bonus or commissions, you definitely want to have the full 2 years of history so that we can make sure that we're, able to factor in your full income amount. Although, if your base pay is large enough and maybe there's not that much bonus or overtime or commission, you might not need the full 2 years. There's also full-time school does actually count towards your 2 years of employment history. So something that people don't realize is right after they graduate, let's say that someone, got a nursing degree and now they just started a job and they're a nurse. They actually can qualify to buy a home because they were full-time in school before now, and now they've gotten a job in their field. So it's pretty awesome that, you can actually buy usually right out of school. Part-time jobs are a little bit tricky. So that's something that we kind of just make sure that we dig into quite a bit. If you have part-time income, got to make sure that that's been really consistent over the last 2 years. And if it's, above and beyond another full-time job, you got to be working both of those for the last 2 years for us, for the underwriters to really feel confident that, you're going to be able to sustain that income. So mainly really what we're looking for is it stable, right? Are we seeing that your income has been stable or growing over time? And that's, something that we help with too, just, making sure that all the numbers look good. And we try to be conservative too. Generally, I think something that we'll kind of talk about is a lot of times people they can, with their debt to income ratio, which I'm kind of getting into the next slide a little bit, but they can afford on paper, technically, and for the loan program, they can afford a bigger house payment sometimes than what would actually be a comfortable home payment for them and like sustainable for them. So that's something that we really do a lot of coaching and education with our clients so that, no one's biting off more than they can chew, which I think is a really big fear right now. let's see, I think we got all this one. So another part of preparing for purchasing a home is looking at credit score or your credit report. So your credit score is going to help give us an idea of what kind of loan programs can we do for you. It's also going to help give us an idea of interest rates. Interest rates are impacted by a lot of things. So credit score is one of them. What we call loan to value, or the amount that you're putting down on a home versus how much is going to be your loan amount. That can impact interest rates. A lot of different things can impact interest rates, but credit score is definitely one of them. So it's good to have good credit. Um, it's easy for me to, talk about this. I've shared with you guys that my mom is my partner here at Guild. And, growing up, she was an accountant and then a financial planner. So, I feel like I learned so much about, just financial literacy and savings. And sometimes it's easy to take for granted, and, you don't realize how much compared to really what's taught in school, which is very little. So that's something that we just love being able to share with people, and, really help them, regardless of where they're at, right? Some people that we talk to, their credit score is in the 400s or 500s, and, they've got some work to do, right? But, we love being able to just help point them in the right direction. One of the things that we do for all of our clients when we do a credit pull, whether it's a soft pull or a hard pull, we have some software we can run that actually lets us know what are some things that they can do to help improve their credit score. So even someone who's got a great credit score, sometimes if you pay off just a little bit, or have your mom remove you from that card that you were on from 10 years ago that you forgot about. Sometimes these little things can actually make a big difference in your score. And then ultimately, when you're ready to buy, your loan program that you get into. So that's something that we help with as well. We also, if needed, we are not a credit repair agency. And we do have a really good company though that we partner with. So if there's opportunities maybe for settling collections, like if someone has a lot of collections on their credit report, but maybe there's an opportunity to settle and delete, which is really key, settling and deleting them from their credit report. So then that negative history goes away. We have a really nice partner that we can connect you with to help with that. Let's see. So when we're looking at your credit score, one of the big things we're looking at is, yes, the score. So we know which programs to look at. But then we also are looking at the minimum monthly obligations, or the monthly minimum payments that are required for you. And that is how we estimate your debt to income ratio. So debt to income ratio is your monthly debt divided by your gross monthly income. And so we look at, and this is all before taxes, right? So it's your gross, your, total amount, your salary before anything is taken out. Generally, loan limits for debt to income ratio are between about 49.9 and 56.9%. But that being said, I would really strongly encourage that you have a lower DTI than that, so that you're avoiding that feeling of being house poor. So one challenge that I see right now for, going through the home purchasing process and getting pre-approved for your purchase, or even pre-qualified, which is a little bit less formal. It's really easy to do that online with, just a few clicks, and you don't even have to talk to anybody. You just upload your information, and a pre-approval letter gets spit out. But the challenge is that it's going to have the maximum amount that you can qualify for. But there's very little education and time that goes into helping you as a consumer understand what that monthly payment's going to look like. So people often will kind of, oh, great, I can qualify for a $500,000 house. And then they go out and they go shopping, and they, get ready to take that on. Maybe even they go so far as to get under contract before they realize what that really is going to look like from a monthly payment standpoint. So it's really important that you have a good team that's going to help explain all of these details really thoroughly, and make sure that you really understand what you're getting into for this biggest purchase probably of your life. We want to make sure that we factor in your whole financial picture. So, for example, we might have a discussion on what is the next 5 to 10 years going to look like maybe for you? Is there a spouse that plans to stay home with kids? Is that something we want to factor in when we're thinking about how we're going to be paying this mortgage? So just make sure that, everything is really going to align with your financial goals. Oh, this picture is really nice. It shows how your credit score is calculated. So I do a lot of tips with helping people improve their credit, but one of my favorite that I think people don't realize is that 65% of your credit score is made up of you making payments on time. So actually making payments and not just having a credit card that has a limit just sitting there and not being used, actually using your credit and making payments on time is really important. And then also having not too big of an outstanding debt. So having a low percentage of your credit that you can tap into, having a low percentage that's being utilized. So one of my biggest tips for anyone that's trying to improve their credit is charging a small amount each month onto their credit cards and then paying it off right away after the statement comes out. So if you charge something and then you pay it immediately before the statement comes out, it's not actually reported to the credit bureaus that you had a balance. So it doesn't show that you're making those payments on time. So charge something like, a tank of gas or something small, right? Buy a pair of socks. Do that. Let the statement come out so it shows that you charged that on there. And then as soon as that statement comes off, pay it off right away. And then you're not going to be getting hit with any interest charges, but you're going to be using a little bit of, not much of your credit, and you're going to be making payments on time. So that's going to really quickly help make sure that you're, uh, getting points from the credit bureaus for this, 65% of your score is what that makes up. Another thing that's important to consider when you're getting ready to buy a house is the costs of purchasing. Down payment, so there's kind of two big parts of purchasing a home. There's the amount that you're going to use for your down payment, and then there's closing costs, or what we kind of consider the costs of buying. So the cost of that purchase transaction. Your down payment minimally is going to be about 3% that's required by your loan program, typically. There are some loan programs that actually go as low as 0% that you have to put down. So for example, that would be if you're a veteran and you qualify for a VA loan, if you're doing a rural property that qualifies for a USDA loan, or if you're using one of the special programs that are available to help people who don't have a lot of savings available to purchase. For example, the zero down programs that are available for FHA homes or loans. There's definitely options, but minimally, people typically will put down 3% or even 3.5% for an FHA loan. We generally like to try to do conventional loans if we can for people versus an FHA loan. Conventional loans are kind of the gold standard of home purchase of home loans. But then FHA loans were created because not everyone has really great credit and savings and income where they can qualify for conventional loans. So FHA loans are available as an option to help people purchase, maybe, for example, when they have a little bit lower of a credit score. One of the reasons we like to try to do conventional if we can is because it comes with a little bit less fees overall, so it ends up saving you money over time. But in general, again, when we look at the data with appreciation, getting in when you can is important too. So that's something that we can kind of look individually at and, see, hey, what's the best option for you? Maybe it wouldn't take much to get you to the point where you could do a conventional loan. So maybe we might focus on that at first. But it's highly individualized. The other part of purchasing a home is closing costs. So this is generally going to include any other costs of the transaction. The one thing that isn't usually included, or I guess what we would say isn't usually included in the loan documents, that's kind of a extra that's not required, but is highly recommended, is going to be your an inspection on the home. So having a private inspection, that sometimes people get a little confused between an appraisal and a home inspection. And the second webinar that we're going to be doing, that's going to be talking about the steps of purchasing a home, that will have a lot more. We'll get into this a little bit more again. But essentially the appraisal is something that's required by the bank. It helps make sure that the bank isn't lending more money than they should on the property. So they help make sure that the home is being valued appropriately, based on what you're paying for it. So it kind of protects you, right? So you're not paying more than the home is actually worth, as well as the lender. So there's the appraisal, and then separately, so that's just really looking at the value. Separately, there's a inspection where they look more at the safety of the home, right? The age of the appliances. Does the water work the way that it should? Is everything, there's different add-ons, we can look for radon and lead and all these different things, which is important, right? When this is going to be a long-term home for your family. It's not usually very expensive when you think about, it's kind of like when you're buying a used car. I like to compare it to, taking it to your mechanic to get it looked at for $100. Well worth the $100 to not be buying a really, bad investment, right? When it comes to a car. So that's how I would kind of compare the homeowner's inspection. Let's see. Okay. So now that we've kind of talked through the different costs, let's look at some different loan programs that are available to help people purchase. I will say too, I'm not going to get too much into the weeds with the different costs because every situation can vary so much. But I think generally kind of keeping in mind that the closing costs, it also includes escrows, which escrows are, so the bank holds generally for most people, and we recommend it. They hold a savings account for you from which they make your tax and insurance payments. So tax bills come out twice a year, and you're expected to pay, 50% of the taxes on your home twice a year. They're usually both like June and September, so they're not even 6 months apart. And then also annually, you have your homeowner's insurance that you have to pay for. So, what mortgage companies do, or, banks do, is we have your monthly payment include an extra amount that we save every month, that then from that account, we make those payments for you. So we find we actually give a little bit of a better interest rate when people do those, what we call impounds, or, escrows. Because, for one, it's going to help make sure that the property is insured, which, is good for you and for the lender. And then we also, oh shoot, I kind of lost my train of thought. I'm not sure, I don't remember. But anyways, we do the escrows to help protect you from, and we make sure your taxes are paid. So that's important too. You don't want to fall behind on your taxes. So it's a little bit more reasonable, gosh, I'm just thinking about like my own property tax bill, which is like $12,000 a year. Could I come up with $12,000 in the summer to, pay my taxes? Probably, maybe, but I certainly like that it's reflected in my monthly payments, so I don't have to worry about that. And I find that most people feel that way about it too. Kind of like an automated savings. So some programs that are available to help. So we talked a little bit about conventional versus FHA. Not everybody has a down payment saved, right? Not everybody has a bunch of money for closing costs. So the which I think I said this, but I can't remember. I started getting there. It's usually around, I would say, 3% of the purchase price is kind of a nice estimate for closing costs, but it varies a lot because the taxes in this community are a lot lower than the taxes in another community. I would say generally a lot of the fees are pretty much the same, but the different properties, sometimes there's a difference, mainly for taxes. Also, sometimes in a more rural area, the title fees are a little bit cheaper. But generally, I would say it tends to fall around 7,000 to 8,000, somewhere in there, but sometimes much more if it's a really big house, where then we have to do a lot bigger escrows. So certainly that's something that we could again look at individualized to kind of see, hey, where are you looking? What is that going to look like in your area? Okay, then just a few kind of overview of a few loan programs while we have a few minutes left. Our community lending program is kind of unique. It's one that is available nationally, and it's based on the community in which you're purchasing. So if the community is a lower income community, then you actually can qualify for a lower interest rate as long as this is a conventional loan program. So, you can get about 0.5% to 1% lower interest rate simply because you're buying in a lower income community. So that's a pretty awesome one that's available. As a reminder too, the QR code on here, if you want to take a picture or check that out, that goes to our link tree. One of the buttons on there is an opportunity to book an appointment. So if you want to talk one-on-one about your situation, I'd be happy to do that. Our 1% down program, this is another conventional program. This is actually Guild only. So Guild is kind of unique in that we are a mortgage broker, but then we also we offer programs from many different lenders and banks. But then we also have some that are retained in-house that we end up servicing. So the 1% down program is one of ours, so it's only offered through us. But it's a conventional loan program where we contribute up to $5,000 towards your down payment. So it originally started as, you pay 1%, we pay the other 2%. However, in our area, we only go up to $5,000. So 2% to get that $5,000 maxed out is about a $250,000 home. Because houses in this area tend to be a little bit more expensive than that generally, we find that we found it easier to just say we'll do up to 5,000 because in a lot of cases that might not be a full 2%. So anyways, but still $5,000 to help with your down payment is pretty awesome. And then we do have some protections as well when you refinance later. So that can be a nice option where you get like a no lender fee refinance. Then we also have our zero down program. So there's two different ones technically, although they're really similar. So we usually just go with whichever one is going to give you a better rate. But the Arrive Home and then our zero down programs are FHA programs where they offer 3.5% or 5% assistance to help you purchase your home. And it is paid back through a second mortgage. So essentially in this, for this example, when we're running numbers for this one, we run the numbers for your purchase, with the down payment. And then we look at, okay, now you're going to have this 3.5% or 5% amount in a separate mortgage payment. So you actually end up making two payments if you have a first and a second mortgage, and that one is paid back a little bit more quickly. But it can be a way to, get someone into a home where maybe they didn't have any savings to do that, on their own. So I've actually have had clients use this program where they ended up getting money back at closing because, they got some seller credits to help with their closing costs, and then, didn't end up having to pay. They paid more earnest money than they even needed for their entire purchase. So then they got a check back. So there's definitely things we can do to strategize if savings is something that is a concern, or keeping plenty of money in your pocket so you're not feeling like, oh gosh, I just spent all of my money on my house. Nobody wants that. And actually statistically that's not a good thing. We have there's been studies that it's actually better if you can do a little bit versus having like a super low mortgage payment and know what we call reserve funds. It's actually better for you to have a little bit higher of a monthly payment, but still have some cash reserves. It's just, we see less foreclosure in those instances. So I usually like to help kind of coach my clients on, hey, let's make sure that we have some reserves to tap into. Um, so, lastly, this is kind of a long list because there's so many different loan programs that we do have. Gosh, we could be here all night talking about all the different ones. So, there's, conventional programs, FHA. We talked briefly about VA and USDA. There's also a lot of specialty loan programs. We've done fix and flip loans and renovation loans. Sometimes people don't realize that they could do a renovation loan, and there's FHA options as well as conventional. So that means maybe you buy a house that really needs a lot of work. It's a way of financing that work those renovations that you want to do into your total loan amount. So actually, that's something that when my mom bought her last house, she ended up doing that. And it was a way that then she didn't have to pay out of pocket for new floors and painting the whole house. And, but she was able to get the ranch where she wanted it, because we can't always choose exactly. We can't always choose all the things about a home. So, and it can be hard sometimes to afford like a perfect turnkey ready home. So this can sometimes be a nice way to personalize it and make it yours without having to pull too much out of your savings in the moment. A lot of these programs, keep in mind, if it's a specialty loan program like that, it will probably come with a little bit higher of an interest rate than just your standard, conventional or FHA. But in the long run, maybe that is the best for your situation. So again, that's where just kind of talking through your goals and what is most important to you really plays a big role. So that is all I have for you guys. And oh my gosh, it's 6:58. How a perfect timing. Really glad I didn't try to cover everything today. But as a reminder, we are going to be doing 2 more seminars. So the next one, I don't have dates yet, I'm sorry, but I'm going to do another one probably in July, early July, where we're going to be talking about the steps of buying a home. So we'll get into, the nitty gritty of pre-qualification and pre-approval and what documents are needed and all that stuff, because I feel like this information isn't always readily out there. So I'm excited to share that with you guys. Also, the last one, we're going to be talking about getting started with investing and kind of just some home when you're investing in real estate, kind of some basics for that. So if you guys would like to stay tuned, the Eventbrite page where you registered for this event, if you want to make sure that you just follow our page, that way when I post another event, you'll be notified. I'll probably I have a list of, who attended, so I'll probably try to invite you as well. But thank you all so much for participating. I do have a minute. Well, technically I'm at time, but I will stay on for a couple of minutes if anybody has any questions. Or, here's that QR code again if you do want to just, book a time to talk with me individually. But are there any questions on your mind right now? My pleasure, Colin. Thanks for coming. Yeah, feel free to use the chat. I completely forgot to mention the chat. I'm going to stop recording.